Welcome to another edition of Graphing with Mr. Molden for AP Macro. Today we're going to be looking at the money market graph. The money market graph is a graph for the demanders of currency and the central bank, otherwise known as the Federal Reserve in most cases. So if you like to spend money, whether you're a household, a business, the government, or the rest of the world, this market is for you. Also, if you're the Federal Reserve, this market is for you. So here is the money market graph. All right, the money market graph acts just like all other supply and demand graphs, with one little twist. So let's break down the components. All right, we have the price of the money market is nominal interest rates. We are not interested in dealing with inflation because those people that spend currency spend it right away for the most part, and so they're not looking for long-term investment, and so we don't have to deal with inflation. All right, and then it is also measured in the quantity of money. So surprise, surprise, if we're looking at the money market graph, we're going to be measuring the quantity of money. All right, demand of money. All right, the red line here is downward sloping like most other demand curves, because at high interest rates, we don't demand a whole lot of currency. Here's why. At higher interest rates, you're more likely to hold on to your money in a bank. So you would have lower demand for currency. And as interest rates drop, you would demand more currency because you're not making as much in the bank. And so you would hold on to your currency to spend it. Alright, so there's your demand line. Now notice the supply curve line, instead of having an upward slope, is vertical. Alright, here's why. It is not dependent upon nominal interest rates because it is controlled by the Federal Reserve and the Federal Reserve only. Alright, so demand of money controlled by households, government, businesses, the rest of the world. And we are dependent upon nominal interest rates to kind of give us a guide for how much currency we would demand. Not supply money controlled by the Federal Reserve has no bearing on interest rates because their one function in this market is to control the supply of money. Like other supply and demand graphs, those supply lines and demand lines can shift. All right, right is increase, left is decrease. Doesn't matter what line you're talking about. So let's look at each of these lines. The supply line is controlled by the Federal Reserve. It's vertical. All right. The Federal Reserve can control the supply of money in three ways. They can change the discount rate. They can change the open market operations, which is just the buying and selling of bonds. Here's a quick way to remember how buying and selling bonds would impact this graph. Buying bonds equals big bucks, increase in the money supply. Selling bonds equals small bucks, decrease in the money supply. The Federal Reserve can then lastly change the required reserve ratio, which is the amount of the ratio of loans that banks have to hold on to. So by changing this, they change the amount of the money that banks have to loan out. It would then change the supply of money. All right, demand of the money market, red line there, is controlled by the GDP, all right, which is mainly influenced by, in this graph, the price level. But anything that impacts GDP would impact our willingness to have money and need money to spend. So if we have an expansion of the GDP, we have more money in the market, we are demanding more currency at each and every price interest rate. Real quick review once more. Nominal interest rates is the price of the money market. Quantity of money is the quantity of the money market. Demand of money, downward sloping. Supply of money, vertical because it's controlled by the Federal Reserve. Very important graph for the AP test. Make sure you know how to label and draw this graph.